Hi, everybody. I'm Reid Johnson, president and founder of Lake Point Advisory Group. We are super excited to have you on our online Food for Thought event. As always, this is our 2021 Q1 market and review and looking ahead to Q2. Lake Point Advisory Group is an investment advisory firm and wealth management financial services firm. We host these monthly events on a variety of different topics that we hope are beneficial to our clients. And we try to keep them around retirement, but sometimes they're a little fun. Today is going to be a little bit more serious. We're going to talk about the actual markets for the last quarter and a look ahead. We have a large audience with us today, so I want to thank you for joining. Everyone's camera and microphones has been off, but we will take questions. So if something comes up that we're talking about, and you're like, you know what, this made me think of something, there's a little questions box, a Q&A icon at the bottom of the screen. Feel free to type your question in there, and Rob, myself, or Eric will try to get to those, as many of those as we can. We also had a few people send some emails with some questions, and we're going to try to get to a few of those today as well. Today, we're glad to welcome Rob Emrich, our Chief Investment Officer, and Eric Burnham with us today. A little bit about Rob, if you're new to our firm or if this is your first time seeing one of our Food for Thoughts. Rob Emrich III, to make it official right there, is on Lake Point Advisory Group's investment committee with over 20 years of investment experience. He and his team are currently involved in developing and managing investment strategies, including hedging market risk and volatility. Rob has recently been quoted in Reuters, Yahoo Finance, Business Insider. I mean, I feel like he's always on the news somewhere talking about the markets. And also, he lives in Austin with his wife, Nicole, and their 2 children. A little bit about Eric, over to the right of Rob. He's our special guest today. He is also a certified chartered financial analyst. Eric is an investment advisor at Smith Capital Investors. They're one of the actual managers that is in our portfolios. He's held this position since May of 2018. Eric's been doing this for over 16 years, so tons of experience. He's seen the ups and downs of the market for sure. Eric's also served as executive director, senior portfolio manager at JP Morgan Asset Management. Eric earned his bachelor's of science degree from the University of Colorado State, earning this distinguished honor, a scholar award, and attended the University of South Australia. Probably maybe we have some questions about Australia. We'll go with you on that one as well. He also, he's going to be here to kind of guide through some of the questions that we had today. So first of all, guys, welcome and thanks for joining today.
Thanks for having us. And thanks for staying the third. My mom will really appreciate that.
That's right. That's right. Well, Rob, I'm just going to go ahead and get this kicked off right away. Give the audience a review of fixed income and equity markets this first quarter. I mean, here's what I have seen. It's like S&P 500 historic high, you know, and it's like, oh, it lost a little bit of it. Oh, it went up a little bit of a wedge to some more. And so it's like, oh my gosh, well, the markets must be doing great. But then all of a sudden it's like, international markets have started going down, fixed income's going down, you have commodities going down. I mean, it's a crazy market. You want to kind of review and do a cap of that?
Yeah, I think a phrase that says it best is the confusion of the confusions. We literally have had a market that has melted up in the outskirts of one of the worst financial crises we've seen in modern history. To that end, as the equity markets are going up, as you mentioned, there are some strains elsewhere in the U.S. On the equity side, you know, we've been fortunate. We chose to maintain a dollar hedge portfolio with our international exposure, and a dollar hedge does well as the dollar strengthens. And the dollar has been strengthening off its lows recently, so we picked up a couple percent there. You'll see it's the for our audience, it's the position IHTG. It's the Wisdom Tree hedged dividend growth equity portfolio. And here we have companies that have very strong balance sheets. And that, you know, as I look at my screen, this is live view, you know, it's up about 9.8%. It's up about 9.8%. We have the S&P up about 12.5%, and SMID caps, small mid caps, are up about 17%. So we've seen some strong returns on the equity side. However, there's been some stress on the fixed income side, and Eric can speak more to that. But essentially, we have seen rates, the 10-year Treasury, you know, jump from a year ago from 90 bips up to 172, 173, and that happened very fast, put some stress on our fixed income portfolios. The index, as we measure by the AGG, the Bloomberg U.S. Aggregate Bond Index, it's down about 2.7% year to date. And our bond portfolios are actively managed. Most of them, they're down about 2 and some change. So that creates a little bit of conundrum. When you look at your portfolio, you see on the news all-time highs, but you look at your portfolio, you might be up, if you're conservative, you might be flat, up 1%. If you're moderate, you might be 4 to 5%. And that is because we maintain diversified portfolios. And that means that some of your portfolio isn't always going to be doing well. But should things shift, turn the other way, they can act as a catalyst in the portfolio.
Yeah, that's something that I talk to the families that I personally work with, and I know all the advisors that work with you hopefully are talking to you about that, is the importance of diversification. It's like, everybody would love to be in equities when they're sitting here all-time high, but if you see the emails and the questions that are already coming in right now, it's like, I'm concerned about this and I'm concerned about this. And so if I have 100% of everything and what's doing good, and I'm not diversified in some of the things that, will help in the event that the market goes down, I think that, people could be in trouble. So I think pointing out the importance of diversification is super important. This next question is for you, Eric. I kind of hit on that just a minute ago, is that, international markets, started off hot, right? And then we saw some sell off or fall off on that as well. What were the events that impacted global markets this last quarter?
Yeah, I think Rob touched on a couple of these major areas, but on the equity side, we saw a lot that was driven kind of as the outcomes from the blue wave on the election, the resulting stimulus packages that were initially pushed through, continued sort of reopening at different paces across the globe, and different progress there on economic activity, as well as continued monetary and fiscal support that kind of differs by geographic area. And then on the fixed income side, it was really about sort of fears of upcoming inflation, given all this stimulus, the loose liquidity that's in the market, potential for increased government supply as these continued. And so you did see that rapid reaction and readjustment higher in interest rates pretty much throughout the entire quarter. And that gets us back to pre-pandemic levels on some of the longer duration sort of government yields, especially domestically. And the other thing that I think we all have to be cognizant of is the first quarter of the year, we really sort of witnessed the impact of this retail, Robinhood, Reddit type investor behavior and what that can do to markets. And so whether that was single name stocks or impacts in different areas of the market, that's become a new wrinkle that investment managers have to at least acknowledge and pay attention to.
So you're not saying to go buy GameStop right now, right? I mean, is that what you're I think that's
I run a bond portfolio, so that's not in my wheelhouse.
That's right. That's right. All right, Rob, next question is for you. What are the ripple effects that might occur from those events, for the rest of the year? So, you kind of talked about what we're seeing, I mean, as far as, COVID and as far as, international and domestic markets, fixed income is kind of crazy. So what are the ripple effects that might occur, for the rest of this year?
Sure, that's the $1 million question. And it's very difficult to determine, what are the second order effects that are going to occur. I will tell you, I caught a headline, you probably all saw it, about de Blasio opening up New York City on July 1st.
Yeah.
Frankly, I fell out of my chair. I couldn't believe it. If I would have thought the guy was going to shut down New York into 2023. I'm half kidding, but that's very, very positive news. I mean, here you have one of the most closed cities and financially destroyed cities by revenue, opening up 100%. I think that's huge. And that gives me a lot of hope for some other places. We could talk about metrics, but I'll just say this. I've been on a plane recently and my plane was full. I've booked a couple trips, and the expense that I'm paying for these tickets is unbelievable. The prices are going up. Hotels are filling up. I just booked a weekend with my son in Fort Lauderdale, and the prices are through the roof. People are traveling. People are tired. They want to get out. They want to get vaccinated for the most part. And I think that is going to be really good. And we have the possibility of having a very, very strong economic recovery, continued recovery here in the U.S. And I'm excited about that. At the same time, my enthusiasm is a little muted by other areas of the world, like India, where they're having a tremendous time containing COVID. What I'm hoping is going to happen, I'm seeing data that shows the supply of our vaccines is exceeding the demand. I'm hoping that we can help other countries, with our excess supply and help them bring up the speed. So that'll remain to be seen, but that's my hope. So the threats are obviously COVID and, in the US, I mean, things look as good as they could be right now.
So with that being said, would you say that the long-term effect is there's a possibility of, the market continuing to grow, but, there's obviously that concern that it's like, hey, we don't want to be too optimistic and have our hands tied behind our back and make sure that keeping that diversified scale is important, would you say? Or would you say, hey, it's time to take more risk at this point?
Yeah, I mean, I think we are looking at taking some more risk, just a little bit of equity exposure by adding maybe 5 or 10%, maybe up to 15% in some portfolios. But that's going to depend on our ability to look for tools to mitigate volatility. That's what really concerns us. Is, on one hand, you can say, hey, I want to be in equities, I want to participate in that, but there's a risk reward payoff. Are we willing to, go a little heavier in equities to catch another, a couple more percent return, but at the same time, introduce unwanted volatility and more downside. So we're looking for ways where we can, I don't want to say have our cake and eat it too, but have our cake and, at least eat it in a reasonable time. Meaning we're looking for the right instruments to help us mitigate that volatility.
Yeah, and that makes me think about our side of the job, right? Me as an advisor, or your financial advisor, whether it be Carter, David Maxwell, David Kane, Chris Houghton, Cody Followell, Anna Apodaca. I mean, any of the advisors, Aaron, Ryan Overstreet, anybody that you're working with, the thing that I tell people is, when we're sitting down and we're building a financial plan, the biggest mistake that you can do is not stick with that plan, right? And and I have a lot of folks that I've seen. I mean, I think about COVID and some of the phone calls and the panic that I had from folks that were like, hey, this market's down 30, 40, 50%, you know what I mean? Not that their portfolios were down, but they were concerned because they're hearing the news, but yet their portfolios weren't down with that, which allowed them to stick with the plan. Those folks that had significant equity exposure that actually took those things, I saw people who came to our firm after they took the loss, they jump out of the market, and then they missed a good run up that happened on the inside of that. So I think that it's important and twofold. I mean, here we're talking about the investment nature of this, but I think that the planning nature of this is sticking with a plan, making sure that you have faith in whatever the plan is, and basically let that run to the duration. Nothing is worse than when you see a prospective client who comes to our firm and I always tell the analogy, it's like a football game. If you're up by 42 points and there's like 6 minutes left in the game, do you continue to throw Hail Marys to the end zone, or, do you run or do you kneel, right? And it's like, right now, I hope that the greed that's going on out there, because we hear these historic highs, is not influencing people to make unnecessary risk decisions when it comes to the planning of their portfolio. What are your kind of thoughts on that, Rob?
Yeah, I think you hit on a good point, because I'm trained through my training, and our team is trained when events like March happen. We say, okay, where's the opportunity? Do we rebalance into this thing? As horrible as it feels, research shows that that's exactly what you should do. Often when you feel worse, is probably when you should probably be investing the most.
Yeah.
And quite the opposite. So that's why I say, even though the markets are high, we're cautious, because this thing, I mean, these markets are electronic. They're more electronic than they've ever been. They can pull back fast. And the last thing I want to do is try to cowboy this market and take excess risk for some return that could disappear and vaporize in a matter of moments.
Awesome.
We're here to build long-term wealth. And to that end, we have to keep clients invested in the portfolio, dampening volatility and staying diversified. It's like an all-season tire. Your portfolio.
I'm gonna coin that phrase, dampen that. I like to dampen the volatility. That's good. I like that. Eric, what would you add to what we just kind of talked about here?
Well, I think this discussion kind of segues into fixed income's life cycle within broader diversified portfolios. Fixed income saw outsized returns probably for the last 3 years leading up into 2021. And coming into this year, there was a lot of talk of where are you going to go for yield? How can we generate any returns from these starting levels? And while no one likes to see a loss from that sort of asset class that they do view as the dampening to the volatility, this reset we've seen in yields is actually very good from that diversified portfolio mindset. You're now seeing longer duration yields, at least domestically, where you're looking at least neutral to even positive real rates of return, where the yield you can earn is greater or equal to the rate of inflation, which is very positive from a long-term basis, because we've struggled with that, honestly, for off and on for a decade. It also allows, as we think about how we manage our portfolio, we use those long duration risk-free assets as kind of an insurance policy against what's going on the risk side. And so that allows fixed income to fill its natural sleeve within that diversified portfolio much better. So I think that's a positive outlook going forward to sort of that disciplined long-term plan that you and Rob are discussing.
So Smith Capital is a good damper of the diversification, I mean, of the volatility, right? That's what you guys do.
That's our view. We pride ourselves as being a sort of traditional fixed income manager. We're not here to hit home runs from return perspective. People in your seat are paid to take those risks and to allocate that money. It's much easier and much more efficient to do that via equities than it is in fixed income. Our job is to be there on the downside and to protect investors when everything else is struggling, and to be the ballast to that risk exposure. And so that's how we look at managing all of our portfolios across strategies.
Yeah, and I think a good point on that is that if I think about every single person that's watching this video, everybody has different income needs, they have different budgeting needs, they have different amounts of Social Security, they have maybe a pension if they're lucky, and then they have different amounts in their portfolio. And so, the job of us is to basically make sure we have the right diversification mix based on all those little, I mean, it's like puzzle pieces that you're trying to put together. And then, so I don't want somebody on here that's one of our aggressive, a client thinking, hey, I have Smith Capitals. I mean, that's not what it's about. But if you're conservative, moderately conservative, moderate, somewhere in that area, I mean, that's where really this takes place, because if nothing would be worse than being at the beginning of retirement or fully in retirement and equity markets are down and fixed income is plummeting, and or you know what I mean, and you don't have a buffer inside of there to basically take income in. Because the idea of fixed income is markets are down, that fixed income should be holding up, and that's where you take your income from, and that's part of our position. So I think it's important to keep that diversification there, especially if you're taking income, and I'm glad you brought that point up. Rob, was there anything that you saw this quarter, or that was completely out of left field that you just weren't expecting this quarter?
Yeah, definitely. I would say without question, and this was a shock to a lot of people, was the speed with which interest rates rose. It's not unprecedented. It's happened a couple of times in history, but the speed with which rates rose was very unique. To that end, the good news is now that that's behind us, historically when this has occurred, rates have tended to kind of taper down and slow down, and that's what they're doing. So we'll see if that remains, that remains. But that would be the biggest surprise for me, was the speed with which rates rose, and it was just unbelievable.
That's great. Yeah, I've had a lot of people talk to me about that. Too bad we can't see rates rising at the banks right now. That's what we need right now. What about you, Eric? Anything forecasted that you'd consider, that you would like to share with our clients, or that you think they need to know about right now?
I think the biggest thing is the impact of these higher yields and what that means for, as Rob alluded to, the potential return outlook for fixed income as a asset class within that diversified portfolio. Equities obviously are seeing high levels of support, both from new investors and continued money flowing into that market, economic growth continuing to reopen and reaccelerate. So that side of the equation has some nice tailwinds to it. On the fixed income side, your returns are largely generated by the yields you can earn. And so having these higher yields, while painful in the short term as we readjusted there, I think is a very long-term positive. I think at the beginning of the year, we were looking at some portfolios that were yielding close to just 1%. And those portfolios have seen a significant increase. And that different from equities, the yield you earn on fixed income is always there. And so prices may go up or down on our underlying positions and you will generate returns that way. You also have the tailwind of that yield. And so the bigger that tailwind can be, the better. So we look at that, and again, comparing it back to inflation and thinking about things from a real return perspective or inflation adjusted perspective, this reset higher is very supportive of not only the fixed income markets, but also the equity markets, because there is a point in time where negative real returns in fixed income also become a dampener on equity return profiles.
Yeah, and I think about it. I mean, it's kind of like one of the levers too. If yields are decreasing, then you have the ability to have a portfolio that's, obviously in fixed income rising. And so we haven't been in that environment. I've always kind of wondered at what point is this going to come. And so it's happening when you're hearing these historic highs. But I mean, it's kind of, I like the fact that you said that it's a good thing, and I agree 100%. I mean, I think that there's got to be some room for it to actually go back down again versus just being at a low at all time and not having the ability. So I agree. Rob, what are we looking at for Q2 as we allocate our portfolios?
Yeah, as we, it's a challenging environment, no doubt. And, I'll reflect back on some, change that we made, because I don't think we've had an FFT with me on since it's occurred. But, we have the prospect of inflation rising, right? And we have the prospect of interest rate volatility. And there's a position that we added to the fixed income side. The ticker symbol is IVOL, if you get your statement. It's run by a wonderful portfolio manager. In fact, if you watch CNBC or Fox News, you've probably seen her. Her name is Nancy Davis. And Nancy used to run the derivative desk at Goldman Sachs. And let me just tell you, if you're running a derivative desk at Goldman Sachs, you know what you're doing. She started an ETF, which is a fund. She used to be a hedge fund manager. And typically ETFs, at least on the retail side, and this is the retail side what we're in now, they like to see track records and things of that sort. But being from the institutional side, we look at, what has she done on the institutional side? And she's buying TIPS, which have inflation protection built into them. And on top of that, she's putting a wrapper on it that benefits from interest rate volatility. It's incredible. So she's raised in a year and a half, she's over $1.5 billion. Most of that money is institutional money flowing into that fund. Most of it's pensions and very, very, very smart money. But you won't be able to walk into some of your local investment firms and find that investment because they'll say, oh, she's new. Well, we have layers of due diligence. When we go in, we deconstruct and decompose the portfolio. We see exactly what she's doing. I spoke with Nancy a few months ago. I have direct access to her. And it's a wonderful portfolio. So we keep our eyes open for portfolios like that, things that are different and unique, run by someone super, super smart that can go in and make decisions and help protect our clients' wealth and protect their volatility. To that end, I'm always looking, especially in the team, we're always looking on the bond side. If bond returns are muted, we're looking to take a proportion. We're always going to have bonds, don't get me wrong, but maybe take some sort of allocation and find a bond replication type strategy where we're getting income, but not just having boring, stale, dull, zero returns. Not saying that's going to happen, but that's what we're looking for.
So kind of to simplify this a little bit, I mean, in our portfolios, we've chosen to have an alternative kind of hedging bucket that's on the inside of here. And so this would be the manager that you're speaking about here, the basically looking ahead going forward is that we wanted to have something with this rising yield market right now that basically wouldn't hurt our portfolio. I mean, or if not, it had some insulation, but more importantly, if inflation rises, this is going to be a great hedging piece inside of it. I mean, would that be accurate?
Yeah, that's good. What's better about her portfolio is we don't necessarily need rates to rise. Her portfolio has instruments that benefit from rate volatility. So if rate volatility is going all over the place, that portfolio has contracts in it that will increase in value. And we've seen that happen. I mean, she's up, I think, about 3 point. Now, we didn't get it at the beginning of the year, but I'm just giving you year-to-date numbers. She's up like 3.1% year-to-date. So she is exactly the inverse of what the bond index is. The bond index, as I said before, is down, like 2.7%. So think about that. That's almost 5% or over 5% outperformance on the, with a bond proxy platform.
Yeah, I was excited to see that piece in the portfolio for sure. That's great. Rob, I'm going to keep this question to you. What are some opportunities that you're researching for second quarter?
Yeah, so we're thinking, right now, as I mentioned earlier, and just to expand on that, we're looking on ways where we can dampen volatility and maintain exposure to equities, particularly U.S. equities is a primary concern because that's where a lot of our assets are based. We're looking for that. We are looking at alternatives. We do like the commodity space, but the challenge with commodities, Reid, as you mentioned, some of them have been hit, but some have done well. Like copper has just had a 10-year high. The challenge with commodities is they're all traded because we have people that ask us, why am I not in oil? Why am I not in copper? And the challenge with commodities, and I used to trade futures. I've traded a fund, but the challenge is in the futures market, you're buying for a future price, and you have contracts that expire monthly and quarterly, and you have to what's called roll those contracts. And I don't want to get too in depth, but I will tell you this: you can't really use a buy and hold strategy. You buy and hold for this quarter, and then you have to roll till the next quarter. Well, guess what happens? If there is demand for that commodity, take oil, for example. If there's demand for that commodity, you're going to have to pay up to buy that next contract. So a lot of the gain you're going to miss. So you've seen there's been cases where oil has risen $10 and instruments designed to track it were up like 1 or 2%. And so, well, why is that so? And that's because the effect of what's called contango in the futures market. So we are looking for possible commodities exposure where we can get pure exposure without losing out on a gain because of the quirks in the futures market. But we wouldn't buy them in the futures market. We would buy an equity portfolio that invests in the futures. So
Yeah, a lot of some of the questions, I shouldn't say a lot, some of the questions that we've been getting through on the questions here, and then most of the people that have sent are really kind of geared towards like, hey, there's this opportunity here, or this political environment here, or what's going on. And I hope I'm saying this right, but when I'm talking with the families that I work with, I'm like, look, our investment team, the research is not about what to buy like now is late, right? That's like in the past in these type of terms. The majority of the research that we're trying to do is like 3 to 5 year, increments and not making big changes because, if with after tax accounts, there's tax implications by trading too much. And I think about, missing opportunity because you didn't do the research and maybe something was supposed to go down before it went up. So what would you, for people that are asking questions, it's like, I think about homes right now as an example. I mean, here in Texas, it's like through the roof. I mean, you hear about lumber. My wife and I were joking when we went by Lowe's the other day. They had all their lumber stacked outside on the side of the building. And I was like, how can they have gold sitting out there without cameras on it? You know what I mean? So, I mean, that's really what lumber's like right now. I mean, it's like, it's crazy to see, what's going on and it's still continuing to happen. So when there's things that are happening like that and people are like, well, hey, are we looking at any opportunity because this is going up? What would you say to that as far as trying to jump on something that's already in the middle of increasing?
yeah, the way to benefit from lumber is again in the futures market, unfortunately, and there you're trading contracts that are priced at about 10,000 board feet of lumber, which has been in a $250 to $300 range over a year ago, and now it's around $1,400 to $1,600. And by the way, it takes about 16,000 board feet of lumber to build a house. The fact that it's made its move doesn't mean it can't get more expensive, but when you have an asset that's run up that quickly, what I find is people get in the market, and then when they buy in it, they're buying at a high level, so they typically put what are called stops underneath it. And we have an asset that keeps rising and rising and rising. If you get in it, the risk reward metric just doesn't pay off, because if that starts to sell off, and what typically happens is when the price goes up, what happens? More producers come out and produce more of it. And then you see a price drop. There will be a price drop. I'm not saying it's going to be next week. It could be it could be a year from now. Who knows? But when it happens, I will be able to pull you up a chart and say, hey, remember when I talked about this? And it'll be a line straight down. Yeah. That's how fast it's going to drop. Remember, we take an elevator up, but then we drop off and just fall down. I mean, the speed of things going down is what scares me. So I would not try to capitalize on that right now. There's just too many imbalances. It's too hard to predict. And to your point before, when people come with opportunities, we have to remember, and I've said this before, if we want to invest in an opportunity or to overweight in some opportunity that we believed in, by definition, we're 100% invested. So I've got to take that money from somewhere in the portfolio and free it up to put it in this opportunity. So that means that I have to be right twice, and I have to be right big. Because if the asset that I take it from does better than the asset I gave it to, even if the asset I gave it to goes up, net I lose. So it's a very complex system running a portfolio with all the different correlations and everything that exists in it. It's a very difficult thing to do, and I see people do it all the time. Sometimes they're lucky, but most of the time, portfolio is like a bar of soap. The more you touch it, smaller it gets.
That makes sense. Eric, there's been a lot of talk about national debt and the government spending from COVID. How are we mitigating the risk in the portfolios, or at least what Smith Capital is doing?
Yeah, so a lot of what we've talked about here is this rise in interest rates, which is driven by those factors. The big stimulus plan, the new infrastructure bill, a lot of that is going to continue to increase federal level debt. You've got continued quantitative easing from the Federal Reserve. And that's been part of what has pushed interest rates up, along with increased inflation expectations as economic growth starts to rebound. The way we've approached that is from a couple different perspectives. One, as Rob highlighted earlier, we are actively managed, which is just a fancy way of saying that we don't just look like whatever we're benchmarked against. We take very active, very conscious bets or positioning against how that index is positioned. So year to date, when you talk about interest rates and fixed income, not to bond geek out on anyone, but kind of the sensitivity to interest rates that those portfolios exist is expressed in a number called duration, which is kind of how long a bond is outstanding. The index was in the high 6 to 7 year duration on a blended number, or for the US markets. We're running about 75% of that. So significantly shorter, which means our underlying sort of performance was much less exposed to a move higher in interest rates. So that's one way we mitigate it. We also mitigate it through various sort of sub-asset allocations. Within fixed income, mortgages are extremely sensitive to volatility of interest rates, as Rob described. And these are the mortgages that are guaranteed by the government. So we're not talking about the risky sort of default foreclosure mortgages that really headlined 2008. These are guaranteed, so there isn't the same credit risk, but the ability of a borrower to refinance or purchase activity is very, very sensitive to the overall rate environment. And so we manage that sleeve, basically trying to be as long or have as much positive exposure as we can to volatility of interest rates. Because over time, it provides a tailwind to the portfolio where we don't necessarily have to be right in terms of the outright direction of rates. We benefit from moves within rates on its own. And so we do that at different levels within the portfolios. We have spent a lot of time this year investing in corporate credit. Corporations have really strengthened their balance sheets over the last year. You've seen numerous examples of corporations who kind of came in, panicked in April of last year, had to raise emergency liquidity. Nordstrom's is a highlight of this. They issued secured debt, which is basically first in priority if they were to default, paid north of 8% coupon on that. The bond was supposed to be a 5-year bond. They came and tendered for it a couple of weeks ago at a $108 price. So we generated a close to 15% return on this emergency financing as they kind of got their house in order. We continue to see that across corporations. Liquidity is awash in the system. Corporations are looking to take down debt. So we've been very focused there, and especially focused on that shorter duration bucket where we can generate returns that are well above sort of the index level for very short periods of time. And that allows us to spread the reinvestment of the portfolio out. So when we do see moves higher in interest rates, we actually have bonds that are maturing or bonds that are being taken out, and we're able to take those proceeds and reinvest them in the new higher rate environment.
So yeah,
So
so
it's a way to
having that short duration is going to be really huge for that, right? I mean, for buying opportunities, it's kind of like what Rob talked about in the equity side of the portfolios. It's like if you've got to have something to be able to go buy it, but with you doing that short duration, that's how you guys maneuver through that. So you're not rubbing the bar of soap too much, right?
That's the goal. Yes.
Yeah. Right. Good. Rob, there's been a ton of talk about capital gains tax. Obviously, the new infrastructure plan that is being rolled out, right? And so part of the plan, it's the first time with all this spending that we've actually seen talk of, hey, we're going to increase top line marginal tax rates. We're going to change capital gains, potentially inside of this bill. What impact might happen on that of the market? And obviously this, you'd have to speculate here, but what is your kind of guesstimation?
Well, I'm trying to figure out how we're going to tax our way into prosperity, but that's left for another day. I will say this, that historically markets haven't been too impacted by capital gains increases and or income tax increases. But as I mentioned earlier, what scares me most, or not scares me, but makes me think, is the second order effects. What do I mean by that? Well, politicians always make some linear assumption. They'll say, hey, we're going to raise taxes X and it's going to go up, and we're going to raise it Y and it's going to bring in X or whatever. And they make this linear assumption that says, hey, we're going to do this, we're going to bring in, $50 billion. Well, guess what? It never happens that way. It never, ever happens that way. They go out and they spend the money, but they don't raise that much money. Why? Because I got news for you. Rich people are pretty savvy. They're pretty smart. They hire attorneys, they hire tax attorneys, state attorneys, you name it, and they figure out ways around the system. They're not going to raise that revenue. What does that mean? The second order effects of having to raise taxes on everybody else to pay for all the stuff that didn't get paid for the first time. That's kind of how we think. If they're going to raise capital gains to income tax rates, okay. Well, for those people that are now limited to taking a $3,000 loss on their taxes, since it's income tax equal with capital gains, are they going to let people have an unlimited amount to take losses? Is that going to be capped at 3,000 now? Why should it be? So there's questions that need to be that remain to be seen. I'm concerned about the level of spending as a lot of people. And unfortunately, I think they're going to spend more than they bring in, which is usually the case. I don't think it's going to have much impact on the markets now, but the second order effects could be significant. But I will say, just as an observation, a lot of people didn't vote for Biden. It was a vote against Trump. It was hate Trump, and they went and voted. Why do I say that? Because I'm talking to some people in the political world that are saying that the midterms, because of all this, are going to be a blowout by Republicans. So, there's going to be a counterbalance here of things.
You're making a prediction on that, but you won't make a prediction on the market. So.
Yeah. Well, notice I said I've talked to people who said, I'm not an expert in politics, but they're expecting the way that things are going, that a lot of people, there's a lot of unhappy Biden supporters that didn't really know what they were getting. So
I'm going to kind of open this up to questions that we have from the audience here. Mr. Latimer sent a quite lengthy one that I sent to the team to kind of review. I think some of these questions, I'm going to go through a couple of these because I think it will be, really good for people. Some of these are at an extremely high level. And I told David, I said, hey, if he wants to get on the phone with Robert and someone from our investment team, we can make that happen. But a couple of these were really good, so I wanted to make sure to hit them here. Because these are things that I've been talking about. Here's the three things that I say that are the unknowns when I'm talking to families that I work with, is that number one, there's a whole new geopolitical environment that's going on right now. I mean, you got China, that's upset. You got Russia back in the mix, and you got North Korea firing off test missiles again, right? So there's some unknown there. The second thing that I'm looking at is this, there's some of these countries like India or Brazil or, that are just like having serious issues with COVID. And then you talk about this market being historically high and these interest rates being historically low. It's like all these different, things that are happening here. So let's start off with one of those, which is that deteriorating, COVID pandemic circumstances. Like, India right now, it's just so sad. I've talked to my kids about, how lucky we are to, be somewhere like this that is not experiencing that right now, and hopefully we don't. So what if any, with Brazil and India having a harder time than a lot of other areas, what do you see that happening to the equity and bond markets there, both domestic and international?
Eric, you want to start with the fixed income side?
Sure. I mean, I think at a high level, we can talk about there's obviously been numerous approaches to managing COVID cases, vaccination, exposure across the globe. And you look at throughout the last year, we've kind of learned a lot from that. And you saw one approach taken kind of in the Nordics, which was very sort of herd mentality driven. And that was hailed for a long time. It's had some flare-ups, but they've been able to manage that. On the other side of the coin, you've seen Australia and New Zealand basically go into lockdown. Domestically, there's no mask requirements, there's no quarantining unless they're cases, and then they're hyper aggressive about it. But for those countries, they've suffered economically because they've basically cut themselves off from the rest of the world. It's impossible to travel down there unless you're going to quarantine yourself for 2 weeks in a hotel. So there's various ways across the globe. I don't know if anyone can look and say one specific way worked better than others. Obviously, we're seeing tragedy really in some more of the emerging markets and economies in Brazil and India, where we're seeing huge increases in death rates and infection rates. But I think taking a step back and going to the economic level, what you have seen is a lot of stimulus across the globe everywhere, both monetary as well as from a fiscal level. And so driving all the way back down to the fixed income perspective or the bond perspective, that naturally over time needs to be unwound and creates upward pressure on interest rates due to inflation concerns and sort of this winding up of the spring as growth potentially returns. And so what we've been dealing with here through the first part of this year, as well as into the Q4 of last year, is that stutter step of economic reopening and continued progress on our economic growth and what the outlook looks like. If you go back and look at what some of the economic data looks like over the last 4 or 5 months, you're hard pressed to find other periods of time where it's shown as good across as many places. Manufacturing activity, jobs, we still have a service job problem in terms of finding people to fill those jobs. So there's obviously robust demand sort of behind everything. As Rob talked about, traveling anywhere is extremely expensive right now, and airports are packed. And so people have money and they want to spend them. And so for fixed income, that naturally leads to the inflation question. And so on top of the burgeoning deficits that countries are running. So that's a lot of focus for us there. And that's where we see the impact. I think if we go back through a fifth wave or whichever wave we're on at this point in terms of rising infections, despite sort of the progress we made on vaccines, that underlying fiscal and monetary policy support is really holding everything afloat right now. So I think in terms of a temporal, we can manage through this process taking longer than it's going to expect. I'm pretty confident in that because if you think back, it's already gone longer than people thought it would once the vaccines were announced in October, November. And we're still not necessarily to the point people would have expected in terms of personal freedom and ability to travel globally. But we are seeing the rebound in economic demand, and that at the underlying basis is very positive to the foundations.
So I'm going to keep you on that for just 1 second because Mr. Carter asked, he's like, well, what about runaway inflation? Kind of what you were talking about on housing, materials, and fuel. That he you know, it seems like nobody's really addressing that concern. So maybe that's more to actually probably to Rob on that question. It's like, you know, is this a concern? Is this something that we're addressing inside the portfolio? And maybe you can talk about it, Eric, on the fixed income side.
Yeah, that's exactly why we had that IVOL portfolio. We could, you know, potentially increase our allocation, you know, in tandem to what you said about, you know, what's happening in emerging markets, as you mentioned, Reid, in the beginning of the call. International markets started to sell off because emerging markets were doing great at the start of the year. And they were up, you know, 12, 15%. You know, they're sitting up right now, you know, 7.3. So that means they've had a 50% fall when these headlines started to hit. So the impact to supply chains, it's going to be hard to figure out. And sometimes people don't figure out. They just hit a button, the electronic curve. They hit a button and they send the flows to the U.S. So that could actually exacerbate the potential inflation that we're already seeing. I just saw a headline that said there might be a shortage of chlorine this year, which could cause, some type of inflation. So that's something that concerns me. By nature, equities tend to be a good inflation hedge. So I'm not worried about it. But I'm concerned, and my team is concerned. And that is something we're watching, because the Fed, with its, core CPI, they seem to remove items from the metric that measures inflation that count the most, like food and energy. I mean, food and energy, everybody pays for that. So it's something that we're watching for sure. And we believe we've done a good job so far, but we're going to keep our eye on it.
Okay. I'm going to go back to another one of Mr. Latimer's questions, because I think this is good. I have a lot of people kind of asking the same things. Is at what point does it become problematic for the U.S. federal government to sustain its rapid growing federal deficit and debt levels, leading to concerns about investors and federal debt? I mean, I think back to, like, what was it, 2010, when because of the debt increase, and I mean, we were like a third of what we are now, but we were downgraded as a credit, as far as this. I mean, is there any concerns with that? Is there any concerns with the federal deficit versus GDP? If so, I mean, what is the solution for this? I mean, how do you protect yourself against this?
I can start, and then Eric can add to it. The unique thing about the United States, so if you look at Japan and look at some of these countries that have very high debt to GDP levels, the difference with the United States is, because our currency is roughly 63% of global currency reserves, it gives us what's called, you could Google this, a seigniorage gain. And think of it in its rudest form. Think of back in like the Middle Ages, a kingdom that has a currency and it's gold, and somebody figures out, hey, I can scrape a little bit of gold off of each piece, and then all of a sudden somebody notices, and they get away with it for so long. And then when people notice, then it falls apart. We get, because of that reserves, the currency reserves, and because we're the largest currency in the world, we get a sort of seigniorage gain. So there really aren't any models. There's no one like us. It's hard to predict how far we can borrow. My first inclination from people I talk to, and there's wide opinions on this, is we can go pretty far. But then the question becomes, well, when is too far, right? Where we can't go back. And that's the answer nobody knows. But I think it would be wise for us as a nation to have calmer heads prevail, start dialing back the spending. I've seen research that says if we focused on government waste across the board, every department, Pentagon, all the way through to the Department of Education, just everywhere, if we focused on waste first, we would be amazed at the billions, maybe $1 trillion that we would uncover there.
Wow.
But nobody talks about that. Nobody talks about waste. It's all spend, tax, cut taxes. Nobody talks about government waste. And I think that's going to have to be addressed, Reid.
Yeah, I agree. All right. This question is from Jim Milstead. Based on the president's plan, and I'm guessing he's asking about, based on this new infrastructure plan, what are we going to be doing, if anything?
A union-friendly investment with the infrastructure plan, because I think, a lot of, I'm being kind of half funny, but a lot of unions will benefit from that. We'll have to look at the plan to see. We tend to right now get our equity exposure from the S&P 500. And there's a lot of companies in there that'll benefit from this, a lot of them. Do we go out and buy an infrastructure, ETF? That remains to be seen. I would say unlikely, but not impossible. That's something we're watching. We will get exposure regardless. If we left the portfolios the way they are now, we will get exposure from that. Do we double down somewhere? We're not sure, but it's something we'll monitor.
I think it has to depend on what's actually in the plan and what we kind of see in that as well. Okay, that's good. Mr. Pollack asked, how does the high probability of the tax increase, both corporate and personal, affect the investment strategy, long term? I mean, I want you to think about this from a portfolio diversification standpoint, Rob.
Yeah, I mean, long term, when you look back at different time periods, it hasn't had much of effect on investments. I mean, we live in the greatest country in the world, and money's going to flow here. People are going to travel here. People are going to invest here. And, we don't have a crystal ball, so we can't see 5-10 years out, but we know being exposed to the broader economy, having exposure to international markets, bond exposure, mitigating currency risk, we do those things and get the basics. It's like there was a famous football coach who said, I come into these teams, I get a new team, and everybody thinks I'm going to draw up some fancy play, and the reality is we spend all of our time on blocking and tackling. If you get that right, if you get the blocking and tackling right, which we've done in our portfolios, then you can kind of expand it into those other things. And I think from where we stand now, we're very pleased with how our portfolios are constructed.
Good. Well, if nobody else has any questions, I think we got to all the questions today. And as I mentioned, and kind of on a side note, we love the research, Mr. Latimer. I mean, it was very appreciated. So thank you. But if you have more questions on these, feel free to get in touch with David, and we'll get you in touch with the team and try to answer those more directly on the rest of those. I think we've pretty much hit everything today. I want to thank Eric for joining us as our guest here, and Rob, as always, as our investment team. We had a ton of great questions, and thank you for doing this. I appreciate you guys sending them before they come or contributing as we go. If we didn't answer a question, please contact me or any of the advisors that maybe you just didn't want to share with us today. Also, you can email us at service@lakepointadvisorygroup.com, or you can call us at 214-771-3363. Thank you so much for being part of today's discussion. I appreciate it. Thanks.
Thank you.
Thanks, Reid.